Hi, this is Tony Sagami. Hey, let's talk about Japan this week. Japan is the world's second largest economy, only behind the U.S., and it's been that way for about the last 40 years. China, however, is nipping at its heels. But let me give you some numbers first. Japan just reported its Q3 GDP numbers. They're pretty darn impressive. They're up by 4.5% on an annualized basis in the third quarter. For a country that's been mired in a deflationary recession since the 1980s, 4.5% is a pretty darn impressive number. Gee, just think of the cartwheels that President Obama and Ben Bernanke would be doing if the U.S. was growing at a 4.5% rate. But nonetheless, some of that growth is because of Japan's own stimulus program. They spent $570 billion to stimulate their economy, and it's working. But like I said, China is catching up. Let me give you another number. For the first 9 months of this year, Japan's gross total output for its economy was $3.96 trillion. China was right behind it at $3.95 trillion. So you can see they're very neck and neck. It's just a matter of months before China does overtake Japan as the world's second largest economy. But even though China is catching up on its gross economy, remember Japan's a much smaller country. On a per capita basis, according to the International Monetary Fund, Japan is 10 times richer than China. And so there's certainly a lot more opportunity in consumer type goods in Japan than there may be in China. But what's this mean for your Japanese investments? Now, first of all, it's kind of hard to find any Japanese funds that have done really well in the last year. For example, T. Rowe Price Japan and Matthews Japan, two popular large no-load Japanese funds, are both only up around 4% for the entire 12 months. Not a lot to get excited about. But let me give you 3 pieces of advice about Japan. Number one, you should avoid broadly diversified mutual funds and ETFs that focus on Japan. There's just not enough broad growth to do well with those type of funds. Now, number 2 is you want to stay away from Japanese companies that are getting their profits slammed by the strong Japanese yen. Remember, Japan's a very big export country, so that strong yen makes their goods more expensive to foreign buyers like Americans. And so you want to stay away from exporters that deal with more consumer-oriented things. 2 examples would be the consumer electronic giant Sony and Canon. Those 2 are not doing that well. Now, there is one area, the 3rd piece of advice, are those companies that are doing a lot of business in China. And there's 2 companies in particular that seem to be doing a ton of it over there. I'm talking about Komatsu and Sumitomo Heavy Industries. Both those companies are experiencing very rapid sales to China and doing quite well and piggybacking on that giant China infrastructure and building boom. Those are 2 stocks that should be among the very best performers among Japan. You can buy both those on the Tokyo Stock Exchange, but they also both are traded here on the United States and over-the-counter pink sheet markets. The ticker for Komatsu is KMTUY.PK. That's KMTUY.PK. Sumitomo Heavy Industries, their ticker is SOHVF.PK. That's SOHVF.PK. Those are 2 stocks that are kind of your backdoor play to China and 2 of the very best Japanese stocks I think you can own going forward. Until next week, this is Tony Sagami signing off.